Hi, everyone. Welcome to Your Money Matters. I'm Angela Giroux, publisher of the Bauman Letter. And joining me are our Bauman Letter experts, Ted Bauman, of course, and Clint Lee. Now, I always like to start with some good news. This is very good news. Clint, you just closed out your 17th consecutive winning play. That is bananas. I don't know another way to put that. You haven't closed out a single losing trade in Flashpoint Fortunes since you launched it in November. And congratulations to you. Really, bravo. That's incredible.
Thank you.
If you'd like to know more about Clint's options strategy, there's a link above and below. I invite you to check it out. It's some really interesting stuff. And again, really job well done, especially under some difficult circumstances. And speaking of those difficult circumstances, we're going to talk about those today. And I have just one very simple question for the both of you. What the heck is going on? Probably not a simple answer, but it's a simple question. So, if I weren't in this business, I would be shocked to know that yesterday, Thursday, the S&P reached an all-time high, because I'm looking at my trade account and it's not terrible, but I've got some stocks that are up. I've got some stocks that are down. I've got some stocks that are up and down and up and down and up and down, which is how it feels the market is performing right now. It really can't figure out what it wants to do. So Clint, I like to pick on you first. What the heck is going on?
Yep, let's have it. So the first thing that I would point out, you mentioned looking at your trading account, and you got some stuff that's up, some stuff that's down. It definitely feels worse now, even though the S&P has been grinding higher versus where it was just even a couple months ago. And that's absolutely true. That's the case. And I've got a chart to prove that right here. This shows the S&P 500 is the blue line on here, going back about 5 months or so, versus the percent of stocks sort of across the market that are trading above their 50-day moving average. That's the orange line here on this chart. And if you go back a couple months ago to say the start of February, where I started to draw this arrow on here, you can see when the S&P 500 was making a high back then, we had nearly 90% of stocks trading above their 50 days. So that just means there's a lot of stocks that were participating in that uptrend. Fast forward to today, and the market making that new high, as you mentioned, just yesterday, but only 60% of stocks are now trading above their 50-day moving average. So we've definitely seen sort of this dwindling, in terms of the number of names that are supporting the move higher. And so that's why it's frustrating to see the S&P doing what it's doing. And, you look at your personal account and it's not keeping up. This is the reason why. And yeah, to your point, it feels like every day, it feels like there's a rotation. Even this week, and it's Friday as we're recording this, energy stocks ripped higher yesterday. So far today, they're leading the way lower. And you're seeing that across other sectors and industries. And I think a big part of it is just because of just these massive competing forces that are out there right now. So, on one hand, you've got investors sort of positioning for this just surge in economic growth that seems to be, happening right now, even more right around the corner. So here's a chart that shows GDP projections for this year. You can see where we've been at sort of that quarterly average over the last century of just under 1%. So obviously outperforming what we've seen historically by a wide margin. Goldman Sachs, and just a couple of weeks ago, they came out. They expect overall growth this year to hit 8%. That would be the best showing in 70 years. You got to go back to 1951 to see something similar. And a big part of that is because of just all this pent up savings that seems to be out there. So we just got a report this morning on personal income and personal spending. And this is a chart from the Wall Street Journal. You see this there's a 21% increase in personal income in March. And a lot of that has to do with the most recent round of stimulus payments that went out. But because of that, you see this huge gap between personal income and spending, so that the savings rate hit almost 28% last month. That'd be its second highest level ever. The highest level was last year when the initial round of stimulus payments were going out. So just to put that number in context. So just all this money that's set to be unleashed into the economy. But then the other competing forces against that are, especially as it pertains to stocks, is a concern with inflation. Are we going to see a lot of inflationary pressures? What's that going to do to yields? How will that impact valuations? Can we even see, those type of growth numbers with some of the supply constraints in the economy, lumber shortages for the housing market, or semiconductor shortages across, a number of sectors that we're seeing right now. And then the other thing is with taxes as well. I mean, we've heard about early proposals on hiking corporate tax rates, on hiking the capital gains tax rate. So those are all things that can weigh on stocks right here. But there's one other element to all of this that I want to mention. And this is really, all these things coming together makes this one of the most difficult trading environments that I've seen in my nearly 2 decades of doing this. And it's just this massive re-rating of certain industries and sectors, taking all this into consideration. And so let me show you just a couple charts to illustrate exactly what I mean right here. So this first chart I want to show, this is a ratio of the performance of XRT, which is a retail ETF, against the S&P 500 and SPY. And this goes back to about 2012. And what you can see is that this line just was grinding lower for about 7 or 8 years, meaning that those retail stocks, that traditional brick and mortar retail, underperforming the market over that time. But then look at what's happened just over the last several months. Over the last several months, it has erased all of that underperformance, that had occurred over a prior 8-year period. And you see the same thing in the commodity space as well. So here's a similar ratio chart of Freeport-McMoRan against the S&P 500, and you can see, recently this line, after underperforming, surging to new all-time highs. So, what you're seeing underneath the hood then is sort of this massive sector rotation, and that speaks to some of the frustrations that you mentioned, Angela, kind of day to day with everything going on in the markets, and expect it to continue. And one of the reasons I bring that up is because I looked at the momentum component I use as part of our investment process, Point Fortunes, just to see what's ranking at the top. Now, momentum last year was synonymous with growth in tech names, right? I mean, that's where the momentum trade was at. Well, here's a table showing the top 20 S&P 500 names ranked on my momentum factor. I took the ticker and the names of the companies off of here, but left the sectors and their industries on. And there's one tech stock in this top 20, and it's a semiconductor company. Everything else, as you can see, is either in consumer cyclicals, energy, financials, industrials. And so once again, as momentum traders, as factor strategies are seeing the exact same type of data, expect a lot of this choppiness to continue.
All right, now Ted, it's your turn. What the heck is going on? But of course, I'm also going to challenge you to come up with some sort of solution here, but I'd like to hear your thought process and how you arrive at that.
Sure. Well, first of all, I mean, I think, Clint is looking at the evidence, at the outcome. What I want to look at is the backstory. How did we get to a point where all of these things are suddenly springing back to life after having been really not going anywhere over long periods? Commodities, retail spending, all that sort of stuff, all of a sudden it's springing back to life. Well, in the short term, it's stimulus, but there's a bigger picture back here. And that is just the fundamental weakness of the US economy ever since the great financial crisis. And I think that the trick here is that investors have done very well over the last decade and a little bit more, but the average real American wage earner has not done very well. Started only in 2019 to pick up again. So here's some charts that show that. Here's a chart that shows change in GDP from the start of a number of different recessions in 1980, 90, 2001, and 2007. And generally what this is telling you is that from the point of the end of a recession, GDP usually grows fairly quickly. But that didn't happen in 2007. It took, many, many quarters for the economy to get back to even where it was at the beginning of the recession. And it's still very short. And of course, what we're seeing in 2020 is that there's very, very much a V-shaped recovery. But the question is, how rapidly is that line going to rise? Is it going to rise rather like the earlier recessions, where we recover quickly and go straight back up? or whether we recover like 2007, which is long, slow grinding. Now, the reason why I think the 2007 recession was so slow to recover, I'll talk about the impact of that in a moment, but effectively what happened was that we fell below the long-term trend line. Here's a chart that shows US GDP. I've put an exponential trend line on here, which is maybe a little bit optimistic that it would rise at that rate for, a country of the United States size and age. But look at what's happened to the line. I mean, basically, we fell below the trend line starting in 2007. Effectively, we lost a big chunk of potential output in 2007, and we never regained it. Now, a big part of where we lost that output was in fixed capital investment. So building factories, building the capacity to supply things, building, the capacity to build houses, the capacity to do anything. So here's a chart that shows US fixed capital investment. Again, it fell way below the trend line at the great financial crisis, and it's never recovered. So effectively, my thesis is that we have got to a point where the United States economy, because of the reluctance to take full steps to restart it after 2007, 8, this austerity mindset, we have to balance the budget, all this kind of stuff. It basically, US businesses said, well, that's not enough for us to, go and build capacity. We're not going to install more production capacity, if we don't know that the government is committed to making sure that the economy runs at full steam. If people are more worried about interest rates and stock prices than they are about our actual business and the wages of people who buy stuff for us, why should we invest? And so they didn't. So here is an example. This is a chart that shows basically sawmills. This is, sawmills and wood preservation. I couldn't see it very well. But look what happened. It began to fall actually before the great financial crisis as people saw the writing on the wall, right? So they stopped investing in sawmilling capacity because they knew that the housing boom was going to slow down. And it took so long for them to recover that. Basically it stayed below, investment in sawmilling capacity stayed below for a long, long time. It's finally catching up. But the reality is that that's the reason why lumber prices are so high right now. So if you look at something like lumber and you say, oh, prices are out the roof, the Fed has to slam the brakes on the economy. If they slam the brakes on the economy again, then we're going to go back to where we were in 2008, where the sawmilling guys are going to say, sorry, I can't build any more capacity because I don't have the confidence that the demand is there. So what's happening now is that I think that there's a policy decision, and it's what's fascinating to me is that it's unity between the Federal Reserve, led by a Trump appointee, Mr. Powell, and the Treasury Department, which is led by Janet Yellen, who was an ex-Fed chairperson. They are both saying, look, what we want to do is run the economy hot so that we can give the confidence to these companies that are essential to supply to build more supply. Powell said that in exactly those words on Wednesday. He said, I'm not worried about the shortage of housing or the escalation in prices. What I'm worried about is that I don't want those guys to be afraid to build more capacity. So that's where we're at right now. So when you look at this inflation, these opportunities, look at it from the perspective that we underinvested in ourselves for a decade. Now we're at the point where we can do that if we choose to do so. Now there's one other element. I'm going to quickly show two charts. This is one I showed on my Friday video, and that's the gap between hourly compensation and productivity going back to the 1950s. There's no question about it. There was a policy shift in the 1970s, late 70s, picked up steam during the Reagan administration, basically to suppress wage growth on the part of the average American worker, not just the burger flippers, but people who earn salaries, middle-level management, to keep those wages down. And all that money went into profits, which were recycled back into the stock market. They didn't go into investment. And the reason they didn't go into investment is what I just showed you, that there was no confidence that there was going to be a growth in the economy going forward. Last chart shows the share of labor income in the United States. Look at how it dived after 2000, and then particularly after the great financial crisis. It started to take back up in 2019, and then it skyrocketed last year because of transfer payments. The bottom line is that we are at a cusp of a new world, basically, in terms of the US economy. We can either go on to a high growth mode, which is based on shared prosperity, lots of people earning decent wages, able to buy stuff, which will prompt businesses to invest, like like lumber mills, like semiconductor manufacturers, like copper miners, all of them. If we don't do that, they're going to say, well, sorry, we'll rather just raise our prices and, wait for the economy to cool down and the Fed to raise interest rates, and we'll all go back to sluggishness. So fundamentally, the reason the stock market is choppy right now is because smart money knows that's exactly the choice in front of us, and we haven't yet seen what the resolution is going to be. We won't know until Congress takes up an infrastructure bill and some of these other bills and what they do. If they don't do it, we're back to where we were. Slow growth, slow underinvestment, probably see interest rates rise, not because the economy is running too hot, but because prices are going up simply because nobody wants to invest in businesses anymore. That's the choice in front of us.
All right, so wait and see.
So you asked me for my recommendation.
Mm-hmm.
I'm investing in commodities. I'm investing in the companies that are facing this choice, because I'm betting that the money is going to be spent, and that, or at least some of it, and that those companies are going to need to increase their capacity. So I'm betting on companies that are currently under-resourced relative to future demand, betting that they're going to see fantastic growth over the next 3 to 5 years. And some of them are completely anodyne. Unfortunately, sawmills are not typically publicly listed. If they were, boy, I'd be buying them hand over fist. But it's those kinds of companies, the everyday stuff.
All right. Well, thank you both. We'll see how this plays out. And Clint, I look forward to your 18th consecutive win in Flashpoint Fortunes.
No pressure.
We're going to have to come up with some sort of a prize when you get to 20, eh?
Thank you so much for watching. We'll see you next week.